We have a very, very, very busy week ahead of us, and the main macroeconomic point of interest could just be the first quarter GDP growth figure from the USA. The US Bureau of Economic Analysis, or BEA, will release the data on Thursday the 28th of April. Now, normally, GDP growth data is neither use nor ornament when it comes to portfolio allocation strategies or fund or individual stock selection. It is in the end backward-looking, for starters, and financial markets are forward-looking. In addition, the record of economists, let alone central bankers, when it comes to forecasting recessions is nothing short of appalling. The BEA only called the 2007 to 2009 US downturn in late 2008, nearly a year after it had begun. Now, that's not to poke fun. Company analysts are not always that good at spotting or calling downturns either, but it shows how hard it is. And by the time economists have cottoned on, well, share, bond and commodity prices as well as currencies are usually way ahead of them. Nevertheless, this print for Q1 in America should be more interesting than normal, as concerns grow that the American economy is slowing down thanks to rising inflation, higher bond yields, and interest costs on its huge federal, corporate and consumer debts, the impact of the war in the Ukraine, and an end to the fiscal and monetary stimulus which did so much to buoy 2020 and 2021. The headline figure to watch is the annualized growth rate, although I would politely suggest that in itself is a bit of a nonsense, as it assumes the US economy will grow at the same quarter-on-quarter rate for 4 quarters in a row. There's not much chance of that, since change is the only constant that we can really expect. However, the annualized rate is what will be given, so that's what we'll have to watch. And in terms of consensus forecasts, the Atlanta Fed GDP Now survey is looking for 1.1% growth. The US Conference Board is looking for 1.5%. And the Philadelphia Fed survey of 36 experts points to a consensus of 1.8% growth. Note that at the start of January, the consensus estimate was 3.9%, while the comparison from the fourth quarter of 2021 is growth of 6.9%. For reference, for 2022 as a whole, the Conference Board is looking for US GDP growth of 3%, the Philadelphia Fed survey 3.7%, and the International Monetary Fund 3.7% as well after its recent downgrade. Those figures all suggest a slowdown from 2021's rebound of 10%, but nothing like a recession. The company news flow is going to come in a torrent in the coming days on both sides of the Atlantic. First quarter reporting season hits top gear in the US, with Microsoft, Alphabet, Meta, Qualcomm, Apple, Amazon and oil giants ExxonMobil and Chevron all set to release numbers. Here in the UK, we have a long list of full-year results, first quarter statements and also annual general meetings to look forward to, with around a quarter of the FTSE 100 members and a good number of mid and small caps also set to update shareholders. Names which may be worthy of further research include the following, although some of these dates could yet be subject to short-term change. HSBC, Associated British Foods, Taylor Wimpey, National Express and IWG on Tuesday the 26th of April. GlaxoSmithKline, Lloyds, WPP, Persimmon, Aveva, London Stock Exchange, Fresnillo, WH Smith and Drax on the 27th. Barclays, Sainsbury, Whitbread, Standard Chartered, Howden Joinery, Smith & Nephew, Spectris and Lancashire Holdings on the 28th. And, deep breath, Reckitt Benckiser, AstraZeneca, NatWest and Travis Perkins will round out the week on Friday the 29th. But the company which could just cause the biggest fuss in the week ahead is Unilever. Now, I know we looked at this one just a couple of months ago ahead of its full year results, but this first quarter update should be no less illuminating. After all, here we have a company with a fabulous collection of brands and global reach. If any firm can give investors a feel for how companies are managing input costs, pricing and margins, as well as ongoing disruption to global trade flows and the war in Ukraine, well, surely Unilever can. The consumer to personal goods giant share price has yet to recover from the fallout created by January's £50 billion bid, which failed for the consumer products business jointly owned by GlaxoSmithKline and Pfizer, even though boss Alan Jope has promised that no other big deals would now be considered. February's full-year results didn't help sentiment much either, as Unilever warned of margin pressure as it gave forecasts for 2022, and it's by those forecasts that the first quarter estimates will be judged. Unilever's forecast underlying sales growth for the year between 4.5% and 6.5%, helped by higher prices. For the first quarter alone, analysts are looking for a headline sales figure of €13.2 billion. That's an increase of 7.4% year on year on a stated basis, Once you strip out currency movements and acquisitions, then the underlying growth rate is seen reaching 4.4%, toward the bottom end of that target range. Unilever has acknowledged that the higher prices it's been charging could cost it some volume growth along the way, so the mix will be of interest. For the quarter, analysts are looking for 6.3% growth in prices and a 1.7% drop in volume. Unilever only releases profit figures at the first half and full year stages, but analysts and shareholders will look to see whether Mr. Jope is sticking to his forecast of a drop in underlying operating margin to between 16 and 17%. For the moment, consensus is looking for 16.3% for an underlying operating profit of €9.1 billion in 2022, down from 18.4% and €9.6 billion respectively in 2021. That, by the way, will be the third straight drop in operating margins. Mr. Jope's 20% target's getting further and further away, it seems. Attention will then switch to cash returns. Unilever paid out 4 quarterly dividends of 42.68 euro cents each, for a total of €1.70.72 last year, or 146p a share. For this year, analysts are looking for €1.71, 141.8p a share at current exchange rates. Also note that Unilever launched a €3 billion share buyback in February, not that it's done the share price that much good so far. Finally, analysts will look for any strategic update. Following the failed offer for GlaxoSmithKline and Pfizer's consumer products business, Unilever announced a new 5-division structure based on beauty and well-being, personal care, home care, nutrition, and ice cream. Any detailed breakdowns here should be interesting, especially as there's a strong feeling that Unilever is looking to further refine its portfolio and focus on what it sees as the faster-growing areas of personal care and beauty. Thank you for watching. I hope that you and your families are keeping well, and I look forward to seeing you next time.